question is always thrown around, like, what's the number one thing that sets people aside from the successful and whatever else. But honestly, I think it's consistency. People get into real estate for multiple different reasons. Real estate is a beautiful thing because there's a lot of different ways you can invest that allows you to be creative, allows you to create a niche, allows you to pour your passion into something, allows you to build wealth in multiple different ways. But real estate, ultimately, I think people are driven towards this because it's a way for you to take more control over your financial future, and also allows you to create some level of independence, right? I mean, this like passive income and financial independence is always thrown around, and that's true. That happens. It doesn't happen overnight in real estate. Real estate is not easy. Even if you're investing, say, with us on turnkey stuff, which is more on the passive side, like it still takes work, right? You still have to go out and get loans. You got to manage your property manager. So this isn't for the faint of heart, but there's a lot of different ways that you can invest. But it's all about being consistent over time. And what I love about real estate, what I've found out, is that you can create lifetimes of wealth and true generational wealth and true financial independence. Again, it doesn't happen overnight, but it also doesn't take a lifetime to do it.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
In this special episode, we have a gentleman who happens to bring non-institutional opportunities, or I should say institutional opportunities, to the traditional investor by having created a brand called Rent to Retirement, where they really focus on the analytics of which areas to purchase in on strategically to then give investors the opportunity to invest turnkey. This is after this gentleman has had an experience of wholesaling, flipping, management, doing the management business, but at the same time just giving opportunities to investors. Again, having a community of 1.5 million plus investors and being able to get a lot of the bonuses of how he describes the incentives that you receive from building. Again, this is new construction, single family homes, and then being able to sell a certain amount to investors. And if he doesn't sell a certain amount, he's on the hook to buy. We didn't even talk about that entire business model in itself, but that's how he's able to also get something that you would traditionally you'd pay $300,000 for a single family home, get it for $270,000 and be able to give $30,000 back to investors when they buy. Also partnering with a local bank where 5% down on traditional investment properties is able to help other of these investors reap the rewards on the back end or immediately as soon as they buy. And again, what I love about him is what he's able to do. He teaches us how to do ourselves as well in this episode. And going back to the fundamentals, which he talked about, of quite frankly, 4 principles of being intentional where you buy, getting started, obviously getting in when you fit in, and then maximizing all the insurance or maximizing all the financial options that you can utilize and leverage, like HELOCs and refinances and 5% down. And then last but not least, certainly not least, is also maximizing the tax benefits as well, like short-term rental loopholes, which he doesn't talk about because he doesn't do short-term rentals. But short-term rental loopholes would be one, cost segregation would be another, bonus depreciation, like you name it. These are all those 4 pillars that he really just goes in and we talk about over time. But at the end of the day, he talks about the importance of consistency and sticking it around long enough, not jumping from one thing to another, so that you can actually see the fruits of your labor flourish, blossom, and into an event that what he calls a hockey stick event, which you can only see after you stick through the process. So this is, if you are in a position right now, you're just getting started and you're getting like, oh, is this the right thing, or there's got to be another way. There is light at the end of the tunnel with respect to the 4 principles that he talks about. If you're applying those, you will see a brighter day. And that brighter day gets really bright real quick because there is a compound effect that's tied to this real estate thing, that's tied to any experiment, that's tied to any business. And the truth is, most of us are just not staying patient or trusting the process long enough for it to be the thing that works for us. So, with that said, if you are in the position where that might be you, you don't want to miss the episode and some amazing and great reminders for all of us to continue to sprinkle on all of our experiments in the lab for the lab experiments to work for you. Without further ado, we got Zach Lemaster, CEO of Rent to Retirement. Check this out. Real estate experiment. What is happening, y'all? Today I have the pleasure of being in the lab with a gentleman that we're super overdue. Again, I always like to say a true practitioner who has multiple, what I like to call is vertical integration, for lack of better words. I'm very excited to talk about that, to see what came first. And we have the one and only Zach Lemaster, the CEO and co-founder and founder, I should say, of Rent to Retirement. Zach, what's going on? How you doing, brother?
Hey, Ruben, I'm excited to be here. I got to match your energy. What a great intro. Thanks for having me.
Absolutely. Well, listen, you're here in the lab, so all things, are open for experimenting here. So, but I gotta ask you, Zach. So I look at this, when I look at your brand, Rent to Retirement. First of all, kudos on that name. I don't know how you even managed to get that domain. That's a hell of a name right there that you came together with, and I can see you guys are very involved. And you and I were just talking about offline, even in our circle of temporary housing. I know you'll sounds like you might have a few folks going out to the MTR summit. But talk to me. What came first? I understand that you come. Uh, there's a background of optometry. There's possibly service as well that here on the background. But then I see wholesale and flipping, management, business. You have turnkey. What came first? Take us a step back, because I always believe that as entrepreneurs, we're typically either scratching our own itch, and who we are and what we're trying to solve usually reflects in our business. So, what problem were you trying to solve initially? And then before that problem even came, who was Zach before all of the experiments blossomed the way they have today?
Yeah, and by the way, I love the idea. I didn't realize the whole lab thing. Like, I love what you're doing with the lab coat. We're experimenting in real estate in the lab. So, with especially coming from a science background, I appreciate that, Ruben. I love it. So,
Absolutely.
um,
Likewise.
yeah, so I have a background in healthcare. My wife and I are both optometrists by education. So we spent many years going to school to help people see, which we really enjoyed. And I still enjoy it because we practice in a volunteer basis. We have a lot of humanitarian efforts that we do
Love
internationally,
that.
and that's still a passion of ours. Real estate was never one of these things where it's like, oh, let's replace our like get out of our W-2. We just like it. It was just we just kept investing, honestly.
Mm,
But I was commissioned as a captain in the Air Force after I left school. I was on scholarship, and so that's really where I got my first rental property. Is commissioned as an Air Force captain. I used the VA loan, bought a duplex, lived in half, rented out the other half. This is about 15 years ago, and just kept going, Ruben. I never really looked back. And one thing I tell people is every single year since that first duplex that I bought, which is my first house ever, my first primary residence, there's never been a year where I haven't bought real estate. I'm not saying I've
mm,
made money on all those deals, but I've always just stayed consistent to investing. But really, there was this pivotal moment in my wife and I's trajectory investing where our local market it wasn't a super attractive market. It didn't make the most sense for us based on our goals. We're kind of seeing these other people be very successful in other markets, and so we decided to branch outside of our comfort zone, our local area, and actually start investing in other locations where really the numbers made more sense and they were more conducive to our goals. And we struggled with that initially. We had to, research markets. We had to build our teams around that. And so we spent a considerable amount of time doing that. But that was really the birthplace of Rent to Retirement, which we're the nation's leading turnkey and build to rent investment company today, where we basically identify the best markets around the country where there's offer the best returns. And then we stand up our local teams there. So our investors can come in and buy real estate with us and own assets in these productive markets, regardless of their geographic location, their experience level. And we can kind of guide them on how to get started investing in real estate, especially out of state, and diversifying into these different areas and grow from there. But yeah, that's kind of the quick and dirty on my story. I mean, we eventually replaced our income through optometry, and we just kept going in real estate. not because we disliked our jobs, but we just really enjoyed real estate, really enjoyed helping people, just as I know you do, accomplish their goals. So
Yeah. Well, listen, I love that. And what I heard, you mentioned some keywords that I want to highlight here as I'm taking notes because I am in the lab. That's what we do here. So already got a whole page. You mentioned you help people see, which is almost, it's it's kind of interesting that that's your background, optometrist, but at the same time, um, I believe in the service of business. That is actually what you're doing the whole time. Is you're trying to help people see. So it's kind of an interesting um, parody, for lack of better words, right? That you help people see because you're doing that today in real estate with respect to the local market research. But I want to talk about what you said. Something key is, and it's actually very prevalent right now to the message, or at least maybe it's on my reticular activating system. I'm hearing it's that you kept going, you were consistent with investing, and I think that's just so important because it's not like I think sometimes in this day and age, which I want to ask you, since you're very analytical and you strike me as very analytical, but I think people are looking for the quick, like, okay, what's the quickest, fastest, most efficient? But you're saying we kept going and we remained consistent. Can you touch on that a bit? Because I know that you strike me as someone who chooses their words wisely, but I want to make sure that this one doesn't slip through the cracks. What does kept going mean, and what did that look like for you, and why is that so important in this space to keep on going? One thing that comes to mind perhaps is the compound effect of the exponential growth of you keeping on investing, but what does it look like in your lens, in your eyes, no pun intended?
you're pretty good at that, man. I love it. So I think for us, I mean, consistent. I've been on a lot of podcasts, and the question is always thrown around, like, what's the number one thing that sets people aside from the successful, and
Hmm.
whatever else. But honestly, I think it's consistency. Real estate, people get into real estate for multiple different reasons. Real estate is a beautiful thing because there's a lot of different ways you can invest. That allows you to be creative, allows you to create a niche, allows you to pour your passion into something, allows you to build wealth in multiple different ways. But real estate, ultimately, I think people are driven towards this because it's a way for you to take more control over your financial future, and also allows you to create some level of independence, right? I mean, this like passive income and financial independence is always thrown around. And that's true. That happens. It doesn't happen overnight in real estate. Real estate is not easy, even if you're investing, say, with us on turnkey stuff, which is more on the passive side. Like, it still takes work, right? You still have to go out and get loans. You got to manage your property manager. So this isn't for the faint of heart, but there's a lot of different ways that you can invest. But it's all about being consistent over time. And what I love about real estate, what I've found out, is that you can create lifetimes of wealth and true generational wealth and true financial independence. Again, doesn't happen overnight, but it also doesn't take a lifetime to do. And I'm sure you have a lot of these success stories, Ruben, as well, with owning a handful of even midterm rentals that cash flow like crazy. But it's really about consistency, right? Because there's always going to be obstacles. You got to get into the game for one. And you got to stay hyper focused on a strategy and consistently, you know, accomplish that strategy. And then once you become successful, you can branch out to like other asset classes and markets and things like that. But man, if I quit after just the first bad deal we had or the first challenge, I would have never got here, right?
Yeah.
So it's all about learning. It's about staying consistent to education, staying consistent to building, our business, our real estate portfolio, to giving back, and just doing that again. And it's not easy. This is an entrepreneurial journey, right? And you got to be, I guess, willing to put in the work to do that.
Yeah. Uh, I love that, getting in the game. I'm gonna double down on that for a second because one of my partners, great guy, very well branded too. Is Michael Elefante came on probably episode, I can't remember, maybe right around 116 or something of that nature. But he said something that you don't get in where you fit in almost, right? And I know he didn't say it that way, but I'm paraphrasing it that way. And but at least getting into the game. And I think sometimes people ask, well, what's the best model? And I think the question maybe is, well, depends on where you are. What is the best model for you based on where you are? What are your thoughts on that? Considering that there's wholesaling, there's flipping, there's buying turnkey from a company like yours. There's you know what is the framework, right? We talk about you're a health guy, so you kind of the scientist behind, right? I think you can appreciate it. What is the standard operating procedure? What is the framework that I should be looking at if I'm listening to this and I still haven't gotten the game there's so much information. There's tons of Instagram accounts. There's tons of YouTube channels. And you talk about education. I almost feel like there's so much education out there that in itself could probably put someone in their tracks and freeze because they don't know which direction to go. So, talk to me about getting in the game. If it's you 15 years ago, you don't know what you know, or maybe you do know what you know, right? Maybe I should say that you're well equipped. What is the first step of getting into the game? What do I educate myself with first? What are the bare bones that I should start with? Then how do I niche down? Like, what are your thoughts against that? Or maybe Zach, I'm going in a complete other direction that you want to go into, and maybe you got to bring me back to course. Like, how should I think of this getting in the game framework?
When I think about building wealth in rental real estate and real estate in general, I always go back and I'm constantly reminded of this because I've done a lot of different things. We've done midterm rentals, short-term rentals, wholesaling, flipping, all the things, notes, commercial, all residential, all the stuff, right? So multifamily. But it comes back to like true wealth is built in real estate, holding it over the long term, right? There's a lot of sexy things you can do with flipping houses and create. There's a lot of things you can do to create additional capital, and maybe that's a piece of the puzzle. But I think too often people get distracted by the shiny object syndrome, and we've all heard of the analysis paralysis, and that's because there's so much information to consume. There's so many things to potentially do. It's like, what do I do? And you're constantly looking at new things. But at the end of the day, just to bring everyone back to square one, like true wealth in real estate is built by holding assets, buying good properties in good locations, and letting time do what it does over time, right? With real estate compounds, as you mentioned, houses appreciate, use leverage, tenants pay the loans down, you maximize your tax benefits, you cash flow, rents go up over time. Like you consistent and rinse and repeat. So no matter what you do, in my opinion, it should always being focused back at that, right? Of how do I build a long-standing portfolio of rental real estate? Because that's what's going to build true financial independence over time. Now, that being said, if you want to go and do some unique stuff and wholesale and be more an active investor and flip houses, that's fantastic. But it's really just creating another job. You got to know how to invest your money in real estate fundamentally. And I believe that's true for anyone. Okay. And you're building a business doing that. Now, in addition to that, Ruben, I think that it's really important for a newer investor, and we see this all the time, to be realistic about your goals, but also your skill set and your time and your level of risk that you want to take. We all watch HGTV or see these different guys, these influencers that are making these big profits on flips, and like that's the exciting part potentially of real estate. But again, maybe if you have never bought a rental property before, you've never flipped a house, you're not a contractor, you're a full-time, you have full-time W-2 position, you maybe just don't have the time and expertise. Like that's okay. Just be realistic with what a good entry point is and get a good solid foundation. And I'm biased on this because this is really what our company does, is help people get started investing, whether it's their first or 100th property or whatever the case is. Like we help them get started and scale their portfolio, buying in consistent markets where they can have a predictable income. And we kind of manage everything for them and help them build a strategy. But so often we've heard these stories of these guys that, they try flipping houses, and this flip has been ongoing for 2 years, and now they're underwater on it. It's like, and they're like, I hate real estate, or they self-managed it, and they're like, real estate is a terrible idea. And it's like, no, you just have the wrong experience, right? You just have to get started in something that's a small win. Don't look for home run deals. That's another thing. So many people want these home run deals. But like the base hits is what wins the game, right? It's about having just consistency in a portfolio. And as you get that first win under your belt, your first property, I think is so important, not financially, but just like mentally and emotionally, to get in the game, to build that foundation, to build your confidence. And then maybe you can do something a little bit more creative or risky or something like that. But match your expectations with, just be honest with yourself about your expectations and match that with your goals. And just remember, true wealth is built in long-term buy and hold real estate, no matter what other things you do in between now and then with other creative things in real estate.
Love that. So, you mentioned skill, time, risk. One of the things that's interesting, Zach, is I think people sometimes mix the difference between having a real estate business or job versus investing in real estate. Now, sometimes the two could coexist, but I think there's a fundamental difference between, let's say, becoming a wholesaler where it is a job that maybe is a means to an end to then invest. And I think sometimes the strategies sometimes are mixed because sometimes maybe they're better off doubling down on, again, you mentioned skill set, time, and risk, on a skill set that maybe is in a job, or I love business, I'm an entrepreneur. Maybe it's a business that is not in real estate that has high profit margins that then allows you to invest in real estate. Maybe then invest with you, like a company like yourself that does it turnkey, where you don't need to be involved everywhere in the vertical, like have the management and the acquisitions, etc. Now you're building a business. Again, that's not in the investing side, but it's part of the investing. Like, so it's, I think having that clarity in itself is important. But let's say now we do have that clarity and we understand, okay, there's a difference between the business side of real estate and then taking our hard-earned money and investing it so that it's working for us into the real estate. You mentioned, we going back to getting in the game, you mentioned the skill set, time, and risk. So now if we understand that, is there a model again, all things considered, right? People have different kind of situations, but based on your experience with where we are today, and is there a model that allows one to at least gain traction, in for the interest, for this interest of being consistent in that domain the fastest? Like, is there one that you feel is probably the lowest hanging fruit? Maybe I shouldn't use the word the fastest, but lowest hanging fruit that is traditional for most investors to get in to then help them with that stepping stone for that next step?
Yeah, I think so. And obviously, this is tailored towards the individual, right?
Hmm.
If you're someone that's like, yes, I need to leave my W-2 job now, I want to have an active business, and maybe a way to replace that immediately would be an active type of business in real estate. But again, we cannot discount the fact that true wealth is built in real estate. And I always remind people that, and I've seen the journey of this on both ends of it. So I've actually lived this, but real estate growth and growing your net worth and your passive income and just building like financial independence, if you stay consistent, you get this hockey stick growth over time. It's very slow in the beginning. And again, we're talking about buy and hold rentals, right? As just your average cash flowing house that is maybe going up in value over time. The tenant's paying the loan down, it's cash flowing, rent should go up over time as well. You're maximizing tax benefits. Like you will build wealth, but it won't happen just within that first year or two. And so you're kind of wondering like, is this really like, is this really what I want? I'm wanting to move faster, but a lot of things are less tangible, right? Like your equity that you're building through the tenant paying the loan down and the appreciation. That's less tangible than the monthly cash flow. So you just really need to understand the math. But real estate investing is really truly this hockey stick growth, where the first few years may seem slow, and they may be slow because you're acquiring 1-2 rentals a year, whatever the case is. Maybe some people are more aggressive than that earlier on, but you get to this first point. I remember probably about year 4 or 5 in, where we had just bought some single family houses, maybe a couple duplexes in there. And it was in a normal market, a Midwestern market. But just over time, I wasn't paying attention to the equity. I was like all about cash flow in the early years, right? I was like, let me cover my expenses. And that was maybe something like $3,000 or $4,000 a month at that point in time. But then I remember I was just looking at, we have a significant amount of equity. I was running the numbers based on what this property is worth, how much debt had been paid down. And I was like, we have a significant amount of equity, and I'm running out of down payments to buy more properties. So I'm looking at doing a self-directed IRA. I took a HELOC out on my primary. I'm bringing in partners, and I'm just like, how can I scale this faster? And just understanding the math and how lending works around real estate and time, like I realized we have a lot of equity. And so we actually we went through our first 1031 exchange. And so we sold a small portfolio of houses, and we tripled our number of houses in a few short months, just reinvesting the equity. That's not money we had to come up with. That's something that the real estate built, is the equity. And then we were able to triple our cash flow and our net worth. And we were able to buy 3x the type of properties because we sold those assets, and then we didn't have to pay capital gains going through the 1031 exchange. And then we were able to kind of catapult, and we just kept doing that. But Ruben, there's a lot of things I think when I look back about, and I discuss with other, high net worth investors and business owners about like, all right, what are just some like fundamental things you did to get where you're at, right? To build this large portfolio. And there's a few key takeaways. And I think this is very true. So I'm going to mention this on your podcast. The first thing is, These are a few key things like you just have to do no matter what else you're doing. Like if you want to build true wealth in real estate and be successful and expedite that, you really should be doing all these things no matter what else you're doing, and you're buying a whole portfolio. One is get started. We already talked about that, right?
Yeah.
Second is be intentional on where you're investing. And this is something we help people with, of course, but it's like, is your local market, even though you feel comfortable with that, the most strategic place for you to invest? There's a lot of different places to invest. I know
Yeah.
just you're investing in an area you're not located in, at least not right now, right? So, I
Yeah.
mean,
No.
you got to be
Absolutely.
intentional about where you invest, because there's likely another market out there that's excelling, just like choosing a good stock. You got to be intentional about where you're investing. Secondly, you have to maximize all your thirdly, you have to maximize all your resources. So that's what we talked about, like with the HELOCs and, bringing in partners, things like that. But really also maximizing the tax benefits and just understanding how the tax benefits works in real estate. So 1031 exchange is a perfect example of that. Now we have the privilege of operating our business in real estate. So we're real estate professionals, and we
Mm-hmm.
also invest in real estate. And this is all we know, right? I don't do any investing outside of real estate because this is what we know. I think it's Warren
Yeah.
Buffett who said, invest in what you know and
Yes.
nothing more. But
Absolutely.
the fact that we are able to run a very successful business and we don't pay any taxes legally every single year because we buy enough real estate, we run accelerated depreciation to offset
Sure.
all of our active income, right? And that's a great way to give yourself an immediate raise, right? So, I mean, I'm just throwing out a few different tangents and bullet points here for people to think about, but that's powerful. Real estate, because of the tax benefits and leverage, there's no other investment that will come close to it. And if you can be actively taking your depreciation to pay less in taxes, man, you're giving yourself an immediate raise, which guess what? You have more money that you'd otherwise give to Uncle Sam, that you can buy more real estate to get additional tax benefits. And so you get the snowball effect. So I guess I went off on a few different
Yeah, no, it's
tangents
good.
here,
I
but
listen. I'm here. I have my notepad. I'm gonna bring us back because you said so many good things. So you talk about the hockey stick event, which I think is a good reference point. And just for context, and again, everyone's situation is different, but I think we're in an age now of kind of instant gratification. Like, there's a lot of education out there, like 0 to 100 in like 2 months, etc. Just for context, again, things can change. You mentioned year 4 to 5. Would you say that's like a very good baseline? Like if you're setting the expectation down, it's like, dude, you're gonna get into real estate. I like to always say, like, anything I'm committing myself to, it's got to be a whole decade at least before I look back and be like, all right, this was like, you have to commit. And so if you really want to just bring and ground people back and more as an encouragement of like keep going, is that a good baseline with what you know now with respect to where we're like 4 to 5 years? Super, like, let's just say someone's buying a property once or two a year. 4 to 5 years, is that what I should be thinking of, Zach? Or is it really like year 8? Like a hockey stick event can happen for many people at different places, but like what's a good baseline? Because I think it's important for people to understand trusting the process, sticking it through, compound, and good things can take time. But what's your timeline?
yeah, and of course this depends on what your
Of course.
expectations are, right? And like what
Yeah.
you're trying to accomplish. But I would say that first kind of catapult event, that exponential increase, is probably likely around year 4 or 5. Would be a good benchmark, right? Because then you just like us, we have enough equity to go through our 1031 exchange. Just like incrementally increase your portfolio. If you're now, there's a lot of markets even in today's market conditions where houses are still appreciating double digits, both in rents and home prices every single year. Those are a lot of growth markets where there's a deficit of housing. We specifically choose to operate in those markets. So there are some markets where you could shorten that timeline.
Yeah.
And there's different things you can do on lending. Like we have loan options where you can put as little as 5% down on properties, true investor loans. So there's certain things I think that you can kind of hack that
Yeah.
and be more strategic, but that's a good benchmark of like, hey, just commit to 4 to 5 years of acquiring 1-2 houses a year, whatever the case is. And time goes by quick. If you
Yeah.
think back, it's like now, and especially now that we have children, it's like, geez, man. But yeah, I think that's a good starting point.
Yeah, no, that's good. I appreciate that reference point because I think it's good for us to, if you're like in year 2 and you're like, man, like, is this the right path? Because one of the things I was recently reviewing is, I don't know, I think it was one of my mentors who was saying this. He was talking about how like the lack of the ability of people to just consistently see the shiny object but they haven't even they haven't even given the time for the roots to grow. Like they just are like on to the next thing, and it's like, all right, I did this for a year. Oh, let me do this other thing for another year, and it's like dude, it's gonna take more than a year or two, or three, or four, or five, is what we're saying. So I think it's really important for us to think about, to reinforce and encourage that if you're listening to this, trust the process, continue to educate along the way. But there is going to be that hockey stick event, and I can definitely attest to that as well. I want to talk about being a little bit more aggressive, because one of the things you said is getting a little savvy, maximizing on, of course, the financing, the maximizing resources on the tax benefits, and being strategic, 5% down on loan, etc. If you're being more aggressive, one of the things I was going to ask you is, what are some of the aggressive kind of knobs for someone who's listening? Be like, okay, like, I'm ready. I got my first, I got my second, I got my third, but I feel like I can accelerate this. You talked about 5% down. That's a good. Is there any other hacks that, someone might not be thinking about, paradigm shift, that along the way, even looking back, I always look at the things that I'm like not even thinking of, that I should have thought of. What's one thing for you when you're thinking about, again, someone who's in that beginning stage of, who is hungry and is not looking for instant gratification, but is maybe looking for, okay, great, I started one, I started with two. Should I be thinking of a different asset class when I'm in year three? Or should I be like, what is out there that I should be thinking of if I want to be a little bit more aggressive and toggle that a little bit? Again, I'm asking you because I think you're very qualified, considering one thing that maybe is the next topic I want to cover is, like, maybe the place is something where you need to think about. But like, what are some of those things that would help someone who wants to be more aggressive start thinking about, for them to, switch the toggle on to accelerating the hockey stick event?
I think there's a lot of niche things that you can do in different asset classes and locations, and different investing strategies, that you can dial that up. So I'm going to keep my answers broad, though, that would generally apply to everyone. Um, I would say the first thing is, we think about, like, finance. Everyone runs out of capital, okay, and that's
Mhm.
the most limiting factor for everybody. And so you only have X amount of dollars to put on down as down payments, and you got to save up the next X amount of dollars, right? So we think about financial offensive and defensive plays, and how you can really dial that up. Side hustles are a big thing, right? Real estate, that's a beautiful thing. Real estate started as a side hustle for me. I mean, I worked as a optometrist for like almost 10 years, before I really retired full time. And real estate up until that point was always kind of a side hustle. I even started this business. We're still working full time. Um, so you can start a side hustle. That could be a lot of different things. You could, the tax mitigation. That's probably the biggest, most important thing. That if you're not utilizing real estate to offset against your active income right now, and it doesn't matter if you're a real estate professional and you can do that easily, or if you need to go through like the short-term loophole and do some of these things, like,
Yeah.
you need to figure out how you really offset your taxes every single year using real estate, because it's available. And I think we're likely to see a lot of these benefits even be expanded on this year. But those are like some big hacks. Yes, being intentional on where you invest. I mean, the market's everything. We hear about location, location, location in real estate. It's like, well, what does that mean? It's like, invest in a good location. Well, understand market dynamics. Why are you investing in the locations? There's some markets where there's different price points, right? Like, are you beating your head against the wall because you live in an expensive market, and it takes, your average house is $500,000, and it's going to take a significant amount of money to put down. Um, Whereas you could buy 5 houses for that one house in the right market. And we're not talking about low income properties. Like, it just, markets, it's all relative. Using financing, different options there, right? How do you be creative to make, again, 20% down on a typical rental? Whereas if you had a 5% down loan, you could buy 4 houses
Mhm.
with that same amount, right? So we help people do that, being intentional on where you invest, maximizing those tax benefits, also being strategic around just optimization of your portfolio and your time. Here's usually when you're getting started, maybe you're younger, you don't have as much capital, you have a little bit more time. Utilize that time efficiently. And we're not talking about watching social media and just consuming all the books and podcasts. Like, go work for someone, right? That's ahead of you. Find good mentorship. Be conscious about who you take your advice from. Utilize all your resources. So that's the thing. We all run out of capital at some point, but like, look at the different financing options. Understand, like, oh, how can I invest through maybe a retirement account if I have that? Or do you have a HELOC you can take out? How can you strategically bring in partners, raise capital from people? My brother-in-law invests in a lot of properties with us where he's not managing them because we are, but he's bringing in investors where he's just kind of teaching them how to, be savvy investors. And we're providing them with the deals. he puts down zero of the money. They put down an entire down payment. He co-owns them 50%. He has 50% of the income on the properties, the appreciation. Anyways, but it's him hustling to go and create that opportunity. So, I mean, those are maybe some things for people just to think about. But at the end of the day, just try to be aggressive in acquiring more assets sooner. All of us can think back in hindsight, say, what would you have done differently? Well, I wish I would have started sooner, been more aggressive earlier, because I see how appreciation works 10 years later, right? Even
Yeah.
though it's slower. So I don't know. Maybe those are some
No,
nuggets.
no, those are so good because, and I want to highlight a few of those, right? Because the biggest thing with the taxes, you want to make sure you have the right professional that is investor friendly and that understands what you're doing, not like your H&R Block, right? Like we're talking about like a real person who is actually a tax strategist, based on where you're going, and then can do the best of both worlds. That was one of the best hires I made, and he was like enrolled agent EA, like came from a cost segregation firm, you name it, like bulletproof. Like you need that on your team. So do not settle for someone's like, oh yeah, I don't know. Like if someone, I think Steve Jobs said this, right? Like we hire people so they can tell us what to do. You don't hire someone to tell them what to do, right? So if you're telling them what you heard on a podcast, that's the wrong professional, right? They should be bringing these things up to you. Number one. So I can't agree with you more. There's the other one that you continue to bring up that I think is just so savvy is like the resource of the financing. There's so many times, you hear like, oh, I don't have the money, etc. Like speak to a professional who can tell you about different products. As a matter of fact, this happened to me the other day. I was like, hey, can you do like 90% LTVs? Like, yeah, we can. Dude, like had I not asked, I would have been stuck in my head. I'm like, oh no, that lender can't do that. And I was just talking about one lender. I know it exists. So just finding out, asking these questions of like, if you can't, then who can? Like who can, right? Who, not how. I think that's a game changer, 100%. And then the tax loophole, we know that from like the short-term rental loophole. I think that's huge because sometimes you can get back, whether it's a bonus appreciation, etc., or the cost segregation. Like you can get back what you would even be required to put on the down payment by just being strategic. I haven't done that, so can't echo that enough. Experiment Nation, you've heard me talk about how multiple investors across the nation are landing these lucrative midterm rental insurance contracts by making these small tweaks on the branding and marketing side. Especially if you're an existing short-term rental operator, there is a quick and easy shift that you can make with the right guide in place. And because we've launched a 2-day boot camp that not everyone could attend in real time, I've put together a recording where you can get all the materials and all the guides to focus on rebranding either your short-term rental business or your current midterm rental business, so that you can actually have the insurance companies reach out to you. And then day 2 is if you want to actually play offense, how you can reach out to them by listing on the right platforms, etc. If you're looking to get this MTR bootcamp so that you can start optimizing and you can start receiving these lucrative contracts that again provide less headaches, less turnovers, unlike the Airbnb space, you can start receiving inquiries today by having the right guide in place. So please go to experimentrealestate.com/MTR bootcamp or click the link in the bio to make sure you get your hands on the midterm rental insurance bootcamp to fast track your way into landing these lucrative insurance contracts the exact same ways multiple investors have taken advantage of this unknown and untapped niche within the midterm rental
I'm putting you on
umbrella.
The hot seat here. I'm just so curious because I don't think there's a right or wrong, but I'm curious like how your mind works, right? One of the things we started to do, we were actually in New York, one of the most expensive states. So like buying like a single family there or whatever, a 1-bedroom apartment in like in the middle of the city is like you're $1 million plus, right? So we went to invest in Georgia, right? Like that's when we started. So we did not invest in our own backyard. Now you talk about, and this is where I want to get into your market. Part of what you guys do at Rent to Retirement is help people kind of get into the right market. Now, one thing you did say, obviously location matters. We know that. But I'm curious, what's your thought process knowing what you know now, right? There's sometimes I feel like in the beginning we're optimizing for cash flow, and then you also then start getting a taste of like what appreciation really looks like. You're like, oh my gosh, like I should have been, going for that more, or maybe like
when you talked about there's areas that are still have double digits and like equity and appreciation and all that, do you think for one who wants to be aggressive, and again maybe it's not one or the other, but I'm curious what your thoughts are, what gets you out of bed, is it like the equity part that one should be really focusing on? Because we talk a lot about cash flow, and or is, again, we understand this, it depends where you're at, but if I'm thinking and I'm trying to be aggressive, should I be factoring in more equity than the cash flow, or cash flow before the equity? Do I get to a certain point where I have a threshold of cash flow, then I start worrying about the equity? Like, what is your thought process when you're speaking with an investor and you're obviously, that at the end of the day, people don't want to bring home the bag, but along the way I have two options. What is, and I'm not expecting you to say one is right or the other, but is there one that we should be keeping in mind more than the other? Like, let me know, what are your thoughts there?
And I'll take this time to share a little bit more about our business model as well, because I think this is part of this discussion of like where can we really make the ideal investment and
Hmm.
maximize all these things.
Yeah.
I think often people really try to view cash flow and equity as a spectrum when, in my opinion, it's really not. They kind of
Mm.
use it as this dichotomy of cash flow or appreciation or a spectrum, right? Like, and that's maybe true to some extent. I also think that earlier on, newer investors tend to focus on cash flow more because, again, it's more tangible and they can do the math in their head. It's like, all right, if I have, $5,000 passive income per month, that's 60K a year, and that's X amount of houses. Like, um, they kind of tend to focus on that, which isn't wrong. I was there as well. What I've learned over time is like, wealth is generally built through a handful of things, but certainly equity is what gives you large amounts of growth. But then you also have to reinvest that, and do all these other things. Also reinvest your cash flow. But I would say that you should not choose either or. You should be conscious about both. And there
Mm.
are markets out there where you can have your cake and eat it too.
Love that.
You just have to invest in the right location, right? And I would say that there's a lot more that needs to be considered than that. Now, in the early years, yes, maybe cash flow is important. You want enough. My opinion is you want enough cash flow to cover your properties, right? Over time, and certainly if you can yield a 8 to 12% cash on cash return, just net after all debt service and things like that, that's great. That will grow over time as rents go up. But there's a lot of markets that we focus on, Ruben, where you can have cash flow appreciation and equity in your initial investment. A lot of people think about turnkey and they're like, oh, well, I'm buying a newly built house or a renovated house. Like there's no upside. There's no immediate upside. Someone's already done that. Well, our business model works a little bit differently. So we do two things. In turnkey, this is buzzword out there where people talk about turnkey all the time. They think about maybe traditionally when people think about turnkey, it's like this 100-year-old house has been renovated in the Midwest. Like that's not us. We mainly focus on new construction. That's
Mm.
about 80% of what we do. And we do two things in new construction. We build houses. So we're builders. We'll build, at least and manage them for you. But we build less than 10% of the houses that we sell to our investors. The other 90% of the houses that we operate on, we form partnerships with national and regional builders. And these would be, builders everyone's familiar with: LGI, DR Horton, Toll Brothers, Lennar, all across the country, some in Atlanta and your local market as well. So what we do is we go on, because as a community, Rent to
Mhm.
Retirement is a community of 1.5 million investors. We're buying thousands of houses every single year as a community. And so we are able to go to these builders and basically get institutional type of discounts, like Blackstone would coming in buying
Wow.
a whole group of houses. We're able to get those same institutional type of discounts because we're doing volumes, and we're able to pass it on to the individual investor. So this is a way that the investor can be more strategic as well. So for example, let's say you have a $300,000 house that's renting out for $2,500 a month, $2,800 a month, whatever the case is. It's an A-class location. It's new construction. You don't have consistent maintenance on it. Like, it's a good house in a good location that should be set to appreciate and cash flow well over time. Well, coming through our network, let's say there's a 10% incentive. We call them incentives on that, and every deal has a percentage number, usually between 6 to 12%. Let's say that $300,000 house has a 10% incentive. That's a $30,000 incentive that our investor community gets, being a part of our investor community.
Mm.
So they can do that. But the best part is they can take that however they want to. They can take it as immediate equity. So you can buy that house at $270,000, where the rest of the retail market, if you went to the builder directly, buy it for $300K. There's no immediate equity in that. Or they can get that cash back at closing. So you get $30,000 back at closing. So if you're putting 60 or 20% down, which is $60K, you get 30% of that or $30,000 back, half that back immediately, I mean, that skyrockets your ROI, right? You can use it to buy down your
I've
rate.
never heard of that. That's phenomenal.
Well, this is our business model, and it's very unique. This is exactly what we do.
Wow.
Or they can use that same incentive, that 30K. You can use it however you want to buy down the rate. You can get rates into 3% to cash flow like crazy. So let's think
Right.
about this for a moment. If
Smart.
you bought a $300,000 house, it's an A-class area. It's cash flowing with debt service on it. But let's say you put 5% down on it. Let's say you get 10% back. So you buy that 300K house with a local credit union, which we have a partnership with, where you put 5% down on it. It's 15K. You get 30K back at closing. Now you've just acquired an asset, and an A-class asset in a growing market. These are a lot of southeastern markets like Texas, Georgia, Alabama, Carolinas, Florida. These are a lot where we're doing. These are growth markets. Where you put 5% down, you get 10% back. Like, you're buying a property with no money down and putting money back in your pocket, just being strategic, right? So, I
Wow.
mean, my point is that you just need to know about the different buying opportunities and find something that matches your goals the most, right? So,
Mhm.
anyways, that was a long explanation, a little bit self-serving about rent to retirement, but
No, I'm so glad you went there because I didn't even know that you. And I think it's important, right? As you should. I always believe that if you have a good product, it is your duty and obligation to tell the world that you have this good product. Because that, to me, is we that is a game changer, right? Like being able to you have the strategic partnership with the the local bank, 5%. Then you have this incentive that you can only get by being in bulk, right? Uh, I mean, your ROI on that, I just did the math. It's insane.
And I
Um,
didn't even go into the tax side, right? Like, if you're acquiring assets, we have a lot of high income professionals that they don't want to self manage. They want to be hands off,
mhm.
but let's say their spouse could be a real estate professional, or they rent it as a short term rental the first year, whatever the case is. I mean, we have people that are buying millions of dollars of portfolio, putting little to no money down, and saving hundreds of thousands of dollars of tax benefits running cost segs on those. So, I mean, that's just that extra layer.
Yeah,
That's how you truly expedite things and go fast, right?
yeah. That was a perfect case study with it. I'm so glad we went there. Didn't You just kind of naturally went there, but that's the problem that you're solving. I think it's important that people understand that, whether they're working with you. I think there's a huge opportunity, and I would obviously encourage everyone to, if they're listening to this, check it out. Rent to retirement.com. But of course, and this is what I love, right? This is why you're in the lab, right? Because you're not just, you know talking the talk, you're walking the walk. Like, this is what you just told us one investor could do, and you're taking this applicable model at scale, and you're applying it yourself as well, which is what I always appreciate, because there's no paradox of practice over here. That's when you're telling other people one thing and you're doing the other, which is not you, Zach. So we're so appreciative to have you here in the lab. So it's interesting that you mentioned. I like the key takeaway here is that you can have your cake and eat it too. It does take some research. You mentioned the Carolinas, the major growing markets. Just for someone who's listening, well, there is an opportunity for your team to be involved in that process. If they're not, what is one thing that, from your core fundamentals, right? Having the management side, the acquisition side, the looking at large portfolios. When I think the question, as you were saying, that's the question that people think is like, "Oh, all right, tell me the markets." But I always believe in teaching people how to fish instead of giving them fish. So, what are some things that you're looking at that attracts you in these kind of markets that one should be thinking of as they're educating themselves towards doing the right uh, pre-analysis work before they dive into a market? Do you have some big core metrics that you follow?
Yeah, I'll certainly go through that, and I'll also say that there's one, again, stop looking for the home run deal.
Mm,
Once you build out your fundamental criteria of what you're looking for, there's likely many markets around the U.S. that would fit those goals, and there's many very good markets. And I would argue that you probably want to participate in multiple of them over time. Um, Diversification is key. But when we really, what's proven successful for us, and really our fundamentals of looking at markets, we want to be in areas that, one, are below the median house price point for the U.S., which is generally plus or minus 400K. So we want to be in areas like we focus on new construction houses between 2 to 300,000, maybe 350 on some of those. Like that's our bread and butter product. These aren't super luxury houses. They're nice homes in good locations. They serve a purpose because we have an affordability crisis in the US. We have a deficit of housing, especially in the Southeast. We have like a deficit of like 7.5 million houses needed. We want to be in areas that have an undersupply of housing, that have population growth, again, supply and demand. So we want to see areas that are their population is growing faster than houses are being produced in those areas. That means you're likely going to have appreciation both in rents and home prices. You're likely going to keep your house rented. When it comes time to sell your house, you'll have plenty of buyers. Plus, you're in the area where under 400K, like you're in an affordability area where you have lots of runway to go up, and you have lots of people looking to buy, regardless of where interest rates are at. People are always looking to buy in those type of price points. We want to be in areas that have diversity of industries, not just an area that's, say, reliant on one major industry like automotive, oil or gas, which could change, right? That could change in that market. We want to be in areas that are either larger metropolitan areas or suburbs of those. Actually, what we call secondary markets, areas that are within 30, 40 miles of some large metropolitan areas that may not work. The suburbs may be great. Perfect example of that would be like Polk County, Poinciana, outside of Orlando, just 20, 30 minutes southwest or Orlando. Orlando's so expensive. It's highly regulated. It's difficult to make at least the long-term rental make sense there. But you can be very successful. Rents are still relatively high and comparable to Orlando, 20 minutes outside. Home prices are a fraction of it. We want to be in areas that, obviously have population, economic growth. We pay attention to legislation. We pay attention to taxes, both income taxes and real estate taxes. Like those all play a piece into all of this. So, I mean, those are kind of like the core fundamentals. And obviously, the rent to price ratios. We need to be able to cash flow on these houses well with debt in place. We target kind of this 8 to 15% cash on cash return. If you're using typical Fannie Mae financing. So those are kind of our metrics.
Yeah, and certainly not to undermine all the that goes behind the scenes of this kind of data analysis, but is there a place that one could, if again they're listening to this and they just want to have a foundational kind of I guess a foundation for this, is there like a good website that you would recommend or a source that to get someone started if they're not quite ready working with you yet?
I mean, we put out all of our information publicly.
Mhm.
We don't charge investors anything to work with us. We put out all of our information public. We got our YouTube and our podcast. So we're happy to share market analysis there and rental calculators. We make our money from building and selling houses, so we're very adamant about adding value. But really, a lot of it comes down to census data. So if there's just
Census.
one, yeah, I mean, and that's sometimes delayed, right? But there's a lot of sites that are aggregators for different one. I'm trying to think of Bright Investor is a good one. That's a resource we use.
Bright, you
That
said?
Bright Investor, yep. There's a lot of data site aggregators out there as well that will pull some of this stuff together. I mean, if you're in the midterm and short term space, Price Labs is great. As far as like the rental type of income and things like that. But if you're looking for general demographic information,
Mhm.
census data is good too.
That's awesome. I appreciate that. That's sweet. So now I gotta ask you personally, like you've done a phenomenal job just being able to scale and grow. Um I would love to hear going back to the you said you were Air Force and you're optometrist, right, for 10 years, and then you started to scale. At what point did the rent to retirement, because you've done an amazing job with not only the brand but of course the the company in itself and what it offers investors, like at what point 1.5 million investors, I think, if I heard you correctly, at what point did that start to gain traction, and at what point were you like, ooh, like I think we're onto something here?
So we've been in business just over 10 years.
Mhm.
Now I think, this company started from us, my wife and I, just wanting to invest out of state where it made more sense than our local market and start to diversify and participate in the markets that, had a lot more upside than we were seeing locally. So, that was really the impetus to starting the company. And we really, before we even like officially um, branded it. I mean, we were really working in the space prior to that, just helping our other optometry colleagues and friends and family like do the same thing, right? We had a lot of people that approached us and said, "Hey, we see what the success you're having in real estate. Like, can we invest with you? Can you help us? We don't have the time, the knowledge, the energy, whatever the case is. That was the beginning of Rent to Retirement. We're like, hey, there's something to this where there's a need that we could serve beyond just our immediate community. But every year we've really had growth. We've had a lot of success in this space, and I think that just goes back to even over the past, even in different market cycles, right? And that just goes back to us just trying to help to add value. We're passionate about what we do. We're passionate about real estate. I think real estate investing is a lifelong journey. I certainly get excited about investing, and I go through different phases, right, as we all do, of demotivation and motivation, but like find ways to remotivate myself. But man, just almost immediately, Ruben, we're like, hey, there's something to this. And then of course we went through the whole business scalability, which is a discussion for a different show. But adding a team and growing our team and adding marketing dollars and like really make it in a public nationwide marketplace. Like, it's been an evolution. We replaced our income probably within that year 4 to 6 range of just personally investing, not even dealing with a business at all. That was just rental income. So like we were financially independent even before starting the business, and we really continued to scale this out of just a love for what we do and sharing of knowledge. I mean, real estate's just a wonderful thing. Is I know you're passionate about it as well.
Yeah, totally. Do you remember what the your first experiment with someone from work looked like? Did you guys partner on a deal? Did you take their capital and then execute on their behalf? Like, do you remember what that was like? The first,
Oh man,
first,
there's
first, they call it the first 3 deals. What was the framework like? Because I'm sure it evolved over time. But was it just, hey, we're interested, we want to do this with you, or could you show us how you did it? Was it like a consult call? Was it a consult fee? Was it like I'll do it with you? Was it done for you? Like what was it? Do you remember?
Yeah, lots of different stuff. I remember driving because I was stationed in North Dakota, and like at the base there was 30 minutes away
Hmm.
from where I lived, the town. And so I just remember back in the day, they had these little old time headsets that you would still plug in, to the, and I would take calls from, that was when I was running, I had a wholesaling business that I started to build capital to buy more rentals. That was
Yeah.
every single dollar I made from that. I either put it back into marketing or I put it into rental properties. And that was really, really important early on. But like the first few rentals, first one I bought with a VA loan. So did that one by myself. And the second one, there's just a colleague at work. I was just talking about what I was doing. And he was like, oh, this is interesting about real estate. And I had known a little bit more than he did at that point. But we just partnered 50-50 on the next one. And
Yeah.
then I think I brought in the next person to do the next one. So like, early on, that's what it looked like. But man, I was a hustler, just as many entrepreneurs are, like lunch hours, after hours, like,
Yeah.
you got to grind it.
Isn't it fascinating though, Zach, how talking about something is in raises the level of awareness of like, oh, you know what, like this guy seems really serious. Obviously not just talking about it, like taking action on. When I think people see you take action, that's one thing, but like I don't know if you have much to add to that. I know I can attest that first it's like, okay, this guy's really like into this, and then it's like, okay, like how can we do this with you?
You got
um
to put it out in the
yeah.
universe, right? You got to put it
Yeah.
out, even if you're a newer investor. Like a lot of people get that
Yes.
imposter syndrome where they're like, "Oh, I'm not worthy. I've only done one deal, or I haven't even done that first deal yet," or like they're concerned about what people are going to think about them. But it's like, dude, you got to put it out there, right? You gotta surround yourself with like-minded people. You got to put out what you're doing. You got to have that excitement, that energy. Like talk to people about what you're doing, because
Yeah.
not everyone's going to want to hear it. Fine, they'll shut theirs, but you'll connect with the people that do want to hear about it. And like that's how some of the best partnerships are formed, right?
Yes. It's unbelievable. Totally a game changer, and I'm so glad you echoed that. That's like a soundbite in of its own. It's just being able to just talk about what you're doing, regardless of where you're at, and you'll attract the right tribe. And you've clearly been able to do that. That's why I wanted to end with the branding side, because I think what you're doing is phenomenal. But I'm curious, with all the traction you've got, I'm sure you're getting tons of word of mouth. You got a huge community. This is just purely selfish question here, just because I love the idea of building a brand and building a community around a business like the one you've created. Where do you feel you're getting the most traction now? There's just so many platforms. There's like YouTube, there's Instagram, there's this what we're doing, right? Getting on shows. Where do you think is your highest return on investment when it comes to engaging on social media and or any other platforms? And maybe it's meetups in person. I'm just curious in your world, what does that look like?
We've really put in the time, the sweat equity into real estate communities and to our own community. Candidly, we've launched
Hmm.
our academy program, which is a kind of our inner community of people like working more collectively together, and those people are just excelling really well. We've definitely put in also the time and energy on paid media and organic content. Like our YouTube channel is close to 300K now, and this time last year, I think we had 10K followers. So we've had explosion with that. When many years prior we didn't get any traction. So I don't know. Sometimes it's just putting in the time in those areas. I think we're fortunate enough now where we're kind of over that initial hurdle of like being reliant on a lot of the marketing channels, which we were
Hmm.
previously, because the brand is well known enough now where a lot of it's word of mouth and just repeat clients. Man, I love working with investors. Like we sell investment properties and we manage them for investors and help them build a scalable portfolio. But investors keep coming back, right? One, that means they're having a good experience, but also means like
Hmm.
those are clients for life that are going to
Yes,
be repeat
customer
clients and like
value.
build their portfolio and then tell other people. So like that takes time to get there. But I think that's where we're at now is, just word of mouth and brand awareness.
Yeah, two things. Tell us about the academy because I don't think I'm aware of how that's different than the service that you offer on rent to retirement. And then I want to go with the second question, which is around your growth that you had on the YouTube side. So tell us about the academy. What is that?
That's just our internal community. So again, like we don't charge any investors to work with us. They can like we make our money by building and selling and managing houses. They can come to our
Mhm.
platform. Anyone can buy off of it. It's all public information. So I mean, if the inventory is there, we'll still have consultations with you and help you build out a strategy. But we found out of necessity is that there's a lot of people that just want a little bit more hands-on
Mhm.
guidance and to be part of like a community where they can collaborate with
It's
others.
like a mastermind.
Kind of, but it's a broader community. I mean, basically, we charge a few $1,000s to join, and then we actually give that back to you when you invest in an asset. So it's really about encouraging people like take action. It's not really
Mhm.
like a profit center for us, but it's more about just getting people to take action. But we it's an online course. We have meetups and events and online and webinars and stuff where we'll bring in subject matter experts, and it's just
Nice.
about creating more of a community. So that's our academy.
Good for you. And you said the meetups, are they mostly in person or virtual?
It's virtual. We'll do a few in person a year.
Mhm.
Maybe we'll go out and like explore a market, right? Like we're doing a deep dive on like Tuscaloosa, Alabama,
Yeah.
and we'll do a deep dive there with some of by the way, that's a great midterm market. But
Mm.
but the U of A, being there. But yeah, so we'll do that. And honestly, we have community leaders that kind of take charge on that. But it's all about creating that like sense of community and having leadership within the community of people that are like gung ho to do the same thing. Like find deal partners, share their wins, share their challenges. That can be extremely powerful.
Yeah, community is everything. I mean, we've seen what Bigger Pockets was able to create, and I think a lot of us kind of intermingled with that world of BP. And obviously, you're kind of you've done that on your end with rent to retirement. Lastly, you mentioned YouTube. I couldn't let the serendipity go to waste. I think YouTube is a under tapped opportunity to talk about what you love, but then at the same time build a community of people who are going to be interested in what you're talking about along the way, which I think is one of the what a time to be alive. What did you find? You said 10K to 300K ish. What was the it? Do you think it was a tipping point compound effect, or is there something different that you did in how you kind of communicate online, or maybe some kind of format? Just curious.
Yeah, well, we started to one, we hired like professionals in to come in and actually run social media, which was good versus just kind of throwing content out there, and trying to have more of like a regular cadence and intention around the content that we were producing. I never really cracked that code. I don't know if we still have to be honest, because we don't have a huge social media presence, but at least with YouTube. We finally got to a point, and I can't even really put my finger on it, but it was probably having just like more structure to the content and actually having like a team behind it, and just again consistency, just doing that over and over, because Man, we had our channel we've had for 5 or 6 years, and like we would throw podcasts out there and some content, and we don't do anything real fancy, but like once we started to get traction compounded over time. And so
Yeah.
we'll gain, I don't know, 5 to 6 thousand new subscribers every couple of weeks or something like that, and then it keeps going up and up, and that's a good lead source for us. But we're not selling anything on it. We're out there just putting out content, right? Interviewing people about different things. So yeah, I don't know, just trying to add value and put out productive value.
Good stuff. Well, it sounds like you're doing the right thing because 5 to 6 thousand followers come in means that you're getting value out there, and just as much value that we enjoyed you bringing it to our table here on the platform, on my platform. I want to thank you for coming in and showing us how it's done, showing us how to think. I love to understand the framework of rent to retirement so that we can also embody that same framework. And my key takeaway from what I'm hearing, a lot of it is, I know we ended on the segment of social media and compound effect, hockey stick, but it's just consistency, staying educated. And again, I would encourage everyone who just listened to this, just go back to listen to the ways that you can even accelerate the success by being very mindful of the different ways you can, optimize where you're investing, tax strategy, etc. So we covered a lot, and so I want to make sure that we give you an opportunity, whoever's listening, to plug in. What's the best way, Zach, that we can have, whoever's listening to this, regardless of whether they're watching this or listening to this while they're driving, what's the best way for them to tap in with the rent to retirement community that you built?
Yeah, thanks, Ruben. Like I said, we put out a lot of content, a lot of market research. We have a podcast, YouTube, all types of stuff. We're out there to provide value to anyone that's interested to get started investing, learn about markets, scale the portfolio. Our website, we want to drive everyone to the website for all that information, though. That's renttoretirement.com, renttoretirement.com. If you're listening to this in the car and you want to text, like you can text REI to 33777 and get in contact with our team. We're happy to have a consultation with you, talk about investing out of state, talk about maybe some of the loan options we talked about, market data, ultimately add value and help you build a strategy to accomplish your goals.
Absolutely. Then that's rent, RENT, and then 2TO, the word retirement.com. Well, listen, Zach, you came and over delivered as the brand always does. And I always appreciate hearing the master behind the madness and all the experiments that have gone well and will continue to go well. I always like to ask, before you drop, I always like to say, we heard it here first. Zach said he would do this, and he did. What do you want to leave us here with currently? What is next for you? What more can we expect? And what can we get on the record, y'all? What do you got?
Oh, put me on the spot here, Ruben. We got a lot of really exciting marketplaces coming out. I mean, we always have our pulse on, what is the new market? What's the new lending opportunity? What is an area that's just growing? I mean, it's just one of, while the rest of the world is out there raising, throwing their hands up in the air, saying interest rates, and this would be my message to people too, of like, there's always noise. There's always a reason not to, like, whatever, COVID, and look what happened after COVID, right? And now the interest rates are higher. Well, interest rates are a point in time. You can always refinance. In fact, as rates start to come down, it's going to be a buyer's market, and then people are going to complain about buyer market. Like, there's always something. There's always an excuse. But while the rest of the world is out there complaining about something, man, we are nose down in the weeds, like finding the markets that make the most sense. And there's been some crazy good markets that just have been exploding, these little sleeper markets. I love bringing those to our community where it's like, oh my gosh, our house is appreciated, 27% over last year when the rest of the market is stagnant. And that's not sustainable over time, but we want to be in predictable growth areas. But it's like, yeah, because you were in a market that you knew was having this new development and there's a ton of jobs needed immediately, right? So like, and I see you doing the same thing with your niche. It's just opportunistic. So that's why I love real estate. That's what keeps me engaged. And, so we're excited about the new markets we're bringing to the table over this year.
All right. Well, listen, I'm definitely going to be tapping in because data is everything. And I like to going straight to the source. And it seems like you guys are plugged in. So, with that said, make sure you plug into Zach Lemaster that we just had here, founder and CEO of Rent to Retirement, RENTTO retirement.com. And just like that, Experiment Nation, we are out. Experimentation, I believe there are two critical components that will help you achieve your goals very quickly and succeed. Number one, it's information like this that you received on a show, in an episode, and content that you can find on my YouTube channel or anybody's channel. And then there's a community. And the way we've been able to expedite our process, the way people in our community, people that we consult, mastermind members, whoever, they get the information on an episode like this, but then they also have the support, whether it's me guiding them or being guided through a community. There is an opportunity for you listening to be able to expedite your process or even expedite your results that you're seeking by being in part of the community. If that is what you're interested in, we at Experiment Nation happen to have a community devoted to helping maximize your occupancy and your profitability altogether, regardless of which market that you are in. And for that reason, you have an opportunity where you can go to experimentrealestate.com/submit if you're looking to work in an environment that can help you prosper faster. Call out any areas that you might not be familiar in, especially the blind spots. That's where a guide comes in hand, and I would be a pleasure and honor to be your guide. But in order to make sure you're a good fit, make sure you go to experimentrealestate.com/submit so that my team can go ahead and take it and see if you're a good fit to join the mastermind and the multiple programs that we have. In addition to that, I'm also now a YouTube partner, which means that I want to give you more access to information, more access to Q&As, more access to the questions that actually come out of our mastermind that help people expedite the process. We've seen people get anywhere from $4,000 to $5,000 to $6,000 to even $7,000 a month net on just one door by applying the strategies that we use by working with corporations and furnished accommodation in a very strategic way. So if you're interested, make sure you also subscribe, because I'm going to have different tiers that's on YouTube now that we've become YouTube partner. Continue to be the bridge to your success in your lab, and your lab means your life, your goals, or wherever you're trying to head. So make sure you also hit the subscribe button on my YouTube channel. That's youtube.com/real estate experiment. We'll be there. You can also look us up at Midterm Rental Insurance Experiment. We will be there. Make sure you hit the subscribe, because that's when you'll know the tiers that are available to you that make sense for you in your marketplace for your results. Remember, you're only one experiment away. Let's build.